Earnings continue to beat. Retail blows past expectations. Tech's leading today. Yields are falling. And I'm told you're getting a little antsy and thinking about buying some protection in the S&P and the Qs.
Well, when everything gets this comfortable, Scott, and you just mentioned all the different catalysts and why things are doing as well as they are doing, and for all the right reasons, but that always makes me just sort of stand back and say, you know what, I got to look at this thing and decide when I need to put on some of this protection. We're talking about a volatility index that just a month ago was trading basically close to 30, and here we are now about half of that. So, have we gotten a little bit complacent? Maybe, but I think the reaction actually makes some sense because we've had nothing but good news for the most part. And you talk about the retail numbers, those are outstanding. You talk about a lot of what we've seen so far since earnings season sort of kicked off. Those have been pretty powerful as well. We talk about energy. We talk about all these different areas in the marketplace that have been moving. Crude oil just the other day, yesterday, was up and over 63. So there's a lot of different positives right now, I think, in the marketplace. But I think that is the time that you have to sort of sit back and say, I might need to buy some protection. Buy it when you can, not when you have to. When your back is against the wall, you start to panic. That's not the right time. It's times like this where I think you have to take a look, and that's exactly what I'm doing.
All right, fair enough. NASDAQ's, there you go, up 1% as we're talking about it. So, Josh, we've been having this conversation whether it's time to be bullish or cautious. You see that retail number today, and I think roaring 20s. It's the story that you've been telling and that everybody else has been telling for a while, and that's what it makes me think about, right? People are going to go nuts this summer.
So in a typical quarter, you have something like 200 million hitting people's accounts for things like tax refunds, et cetera. In the first quarter this year, it was 600 something million. So a triple of just money being deposited to regular people than what's normal. That's how you get retail sales up 10%. In addition to an all-time high for the Dow, the NASDAQ, also an all-time high for the NDX, also an all-time high for the equal weight S&P 500, an all-time high for Russell 1000 growth. Go take a look at REITs, new 52-week high, commodities surging. If you're having trouble identifying the fact that we're in a bull market, there might be a better career for you to consider. Like Amazon is hiring. This is not a difficult environment. So I think there's a lot of commentary and there are a lot of opinions about things that have never happened before. People seem to be so sure of when this ends, how this ends. I would just point out very simply, if you focused on price action, which is the truth, doesn't mean price is always right, but it is the truth about what's happening right now, it's less difficult. We have blowout economic data, and the stock market has gotten the message. And that is the big thing that I think you need to understand.
Okay.
Now, is it time to be optimistic or cautious? You can always be both. You don't have to lose your mind just because stocks are higher.
But you just said, okay, the market's gotten the message. You're 1,000% right. The question is there more message to get? Or is it all in, right? Things are good. We know that. It's not a big secret,
It should never be all
right?
in. Listen, I agree. It should never be all in unless you're 20 years old and you're using money that you can't touch for 45 years. The typical person watching the show right now knows better. Nobody's all in. And if they are, and they're doing things like using leverage at all-time record highs, they're going to learn a lesson, and perhaps they need to. I think for most people, the hard part now is to stay invested because everyone suffers from what's called the gambler's fallacy. This is a very well-known cognitive issue. It's a behavioral finance issue. Lots has been written on the subject, and people think that the roulette wheel spins and hits red 5 times, the 6th time should automatically be black, or the odds of it being black are higher. And that's just not how this works. So I really feel strongly that if people commit to an asset allocation and accept the fact that things might get worse and then better again and then worse, like accept the fact that you have to live through that, that's a better answer than sitting here day after day after day watching this market grind higher and sitting there in cash like my moment's coming. Right. That's not how successful investors should be carrying themselves.